Last Friday, your paycheck arrived. For a moment, everything felt good. You looked at the number and thought, all right, this isn't bad. But then the money started disappearing. Rent came out. The car payment followed. Groceries somehow cost way more than they used to. A subscription you forgot about charged your card again. Your credit card bill reminded you about purchases you barely remember making. And before any of that even happened, taxes had already taken a chunk. Suddenly, the paycheck that looked big a few hours ago doesn't feel big anymore. For a lot of people, this happens every single month. And the frustrating part is they don't completely understand why. It's not because they're lazy. It's not because they're irresponsible. It's usually because nobody ever explained how money actually works. Most of us spend more than a decade learning things in school, but almost no time learning the basics of personal finance. Then one day we become adults and suddenly we're expected to understand taxes, credit scores, investing, debt, and retirement accounts. So let's change that. Imagine someone named Jordan. Jordan is 27 years old, works a normal job, earns about $60,000 a year, pays bills on time, and still sometimes feels like money disappears faster than it should. Jordan isn't doing anything wrong. Jordan just never got a clear explanation of how the system works. One of the first things Jordan noticed over the last few years is that everything seems more expensive. Groceries cost more. Rent costs more. Eating out costs more. Even basic everyday items feel like they doubled in price. This isn't just a feeling. It's something called inflation. Inflation simply means that money slowly loses purchasing power over time. The same dollar that bought something a few years ago buys a little bit less today. When inflation happens slowly, it's part of a normal growing economy. But when it speeds up, people feel it everywhere, especially in groceries, gas, and housing. The confusing part is that when inflation slows down, prices don't go back to what they used to be. They just stop rising as fast. It's like a car slowing from 90 miles per hour to 30. The car is still moving forward. That's why simply putting money in a basic savings account often isn't enough to build wealth. If money sits still while prices keep rising, its real value slowly shrinks. Around the same time, Jordan tried renting a new apartment. The place was perfect. Good location, reasonable price, and close to work. Everything looked promising until the landlord ran a credit check. A day later, Jordan received a message saying the apartment had been given to another applicant. The reason was a credit score. A credit score is basically a number that represents how reliable someone has been when borrowing money. Banks, landlords, and lenders use it to estimate risk. The higher the number, the more trustworthy someone appears to lenders. This score is based on things like paying bills on time, how much debt someone currently has, how long they've had credit accounts, and how often they apply for new credit. What surprises many people is how much that number can affect the cost of borrowing. Two people can buy the exact same house from the same bank on the same day. But if one person has a much higher credit score, they may pay tens of thousands of dollars less in interest over the life of the loan. Another thing people often misunderstand is taxes. Jordan recently got a raise at work. It wasn't huge, but it was enough to feel good about. Then someone at the office said something that made Jordan pause. They mentioned that a higher income might push Jordan into a higher tax bracket. Suddenly, the raise didn't sound as exciting. Many people believe that earning slightly more money could somehow cause them to take home less after taxes. But that isn't how the system actually works. Income taxes in the United States are progressive. That means income is divided into portions, and each portion is taxed at a different rate. Only the income within a certain range gets taxed at that rate, not the entire salary. So if someone earns a little more money, they only pay a higher tax rate on the small portion above that threshold, not on everything they earn. A raise always increases take-home income. As Jordan continued learning about money, another confusing topic came up: the stock market. Every day the news talks about markets going up or down. Sometimes headlines make it sound like the entire economy is collapsing. But stock prices move based on expectations about the future, not just current performance. Investors are constantly trying to predict how companies will perform months or years from now. Because of that, emotions can move markets just as much as facts. Excitement, fear, optimism, and panic all play roles. This is one reason why trying to perfectly time when to buy or sell investments is extremely difficult. Even professional investors struggle to do it consistently. When someone buys a stock, they aren't just placing a bet like in a casino. They are buying a small piece of ownership in a real company. If the company grows, becomes more profitable, and expands its business, the value of that ownership can increase. Over long periods of time, businesses tend to grow along with the economy. That's why long-term investing has historically been one of the most effective ways to build wealth. One of the most powerful forces behind long-term investing is something called compounding. Compounding happens when returns start generating their own returns. Imagine planting a small tree. At first it grows slowly, but over time it grows branches, then more branches, and eventually the growth starts accelerating. Money can work the same way. If someone invests a small amount regularly for many years, the growth can eventually become much larger than the original contributions. Time is what makes this process powerful. Starting earlier gives money more time to grow and compound. Compounding can also work in the opposite direction with debt. Credit cards often charge high interest rates. When balances aren't paid off quickly, interest builds on top of previous interest, causing debt to grow faster than many people expect. Jordan eventually learned about retirement accounts offered through work. One of the most common in the United States is the 401k. Many employers encourage employees to contribute to these accounts by offering something called a match. A match means that when an employee contributes money to the retirement account, the employer adds extra money as well. It's essentially part of the employee's compensation that only appears if they participate in the plan. Despite this, many workers never enroll, sometimes because they don't fully understand how it works. Another lesson Jordan discovered was the difference between saving and investing. Saving money is important for emergencies and short-term goals. Having a financial cushion can prevent small problems from becoming serious financial stress. But long-term wealth often grows through investing rather than simply storing money in low-interest accounts. Jordan also began thinking about debt differently. Not all debt has the same impact. Some forms of borrowing are used to purchase assets or opportunities that may increase future earning potential. Other types of debt are often connected to everyday spending and high interest rates, which can make financial progress much harder. Another concept that helped Jordan understand the bigger picture was net worth. Income shows how much money someone earns each year. Net worth measures the difference between everything someone owns and everything they owe. Two people might earn very different salaries, but still end up with similar financial positions, depending on their spending, saving, and investing habits. Housing was another mystery Jordan tried to understand. Many people feel like buying a home has become much harder in recent years. One reason is simple supply and demand. In many areas, there are more people looking for homes than there are homes available. Construction costs, zoning rules, and population growth all influence housing availability, which in turn affects prices. Banks also play a major role in the financial system. When people deposit money, banks don't simply store it in a vault. Much of that money is loaned to other borrowers. The bank earns interest on those loans, which becomes a major source of revenue. Eventually, Jordan heard people talking about recessions. The word often appears in headlines during uncertain economic times. A recession is generally a period when economic activity slows down. Businesses may earn less, hiring may slow, and financial markets can become volatile. But historically, recessions have always been temporary phases within longer periods of economic growth. Understanding that history helped Jordan avoid reacting emotionally to every piece of financial news. Over time, Jordan didn't become a financial expert or a millionaire overnight. But something important changed. Jordan started tracking spending more carefully, investing consistently, avoiding unnecessary high-interest debt, and contributing regularly to retirement savings. None of these steps were dramatic on their own, but repeated over years. Small financial decisions can create very large differences. The biggest advantage in personal finance usually isn't secret strategies or complicated investments. It's simply understanding the basic rules well enough to make steady decisions over time. For many people, once those basics become clear, money stops feeling mysterious and starts feeling manageable. And that alone can change someone's entire financial future. Jordan didn't realize how many small financial decisions were shaping the future. At first, everything still felt the same. The job was the same. The paycheck looked about the same. The bills didn't magically disappear. But something slowly started changing. Instead of wondering where the money went every month, Jordan began noticing patterns. For example, There were small expenses that seemed harmless at first. A few food deliveries each week, subscriptions that charged automatically, random online purchases that felt cheap in the moment, but added up by the end of the month. None of these things looked dangerous individually, but together they quietly drained hundreds of dollars. Once Jordan became aware of it, the spending habits started shifting, not in a dramatic way. There was no extreme budgeting or cutting out everything enjoyable. It was simply about paying attention. That awareness alone created extra money at the end of each month. At first, it wasn't a huge amount, maybe $100, sometimes $200. But Jordan remembered something important about money. Small amounts grow when given enough time. So instead of letting that extra cash sit in a checking account, Jordan started putting it into investments regularly. The first few months didn't look impressive at all. The numbers barely moved. Some days the account even went down. That part surprised Jordan. Most people imagine investing as something that constantly moves upward. In reality, markets move up and down all the time. Some weeks feel exciting. Other weeks feel frustrating. Occasionally there are months where everything seems to fall. But over long periods, something interesting tends to happen. Companies innovate. Businesses expand. New technology appears. Entire industries evolve. And the economy slowly grows along with those changes. Jordan began to understand that investing wasn't about chasing quick profits. It was about participating in that long-term growth. Around the same time, Jordan also became more aware of how debt works. A credit card balance that once felt manageable started looking different after learning how interest accumulates. Every month that balance remained unpaid, interest quietly added more to the total. It was like carrying a small weight that slowly got heavier. So Jordan made a simple goal: reduce that balance steadily. Not all at once, not in a stressful way, just consistently. Month after month the balance got smaller. And something surprising happened when the debt disappeared. The money that used to go toward interest payments suddenly became available for other things. That extra cash could now go towards savings, investments, or experiences that actually brought value instead of stress. Jordan also started hearing friends talk about buying homes. Some felt excited about the idea. Others felt discouraged because housing prices seemed so high. The truth is that housing markets move in cycles influenced by many factors: population growth, construction costs, interest rates, and local demand all play a role. In some cities, homes become extremely competitive because there simply aren't enough available. In others, prices move more slowly. Jordan realized that buying a home isn't always just a financial decision. It's also about timing, location, and personal readiness. Learning this helped remove the pressure to rush into a decision simply because everyone else seemed to be doing it. Another thing Jordan discovered was how powerful emergency savings can be. Life always finds a way to surprise people. A car repair appears out of nowhere. A medical bill shows up unexpectedly. Sometimes a job situation changes. Without savings, those moments can create serious stress and force people to rely on high-interest debt. But with even a modest emergency fund, those situations become manageable inconveniences instead of financial disasters. Jordan slowly built that safety cushion over time. It wasn't glamorous. There were no exciting headlines about it. But knowing that money was there created a feeling of stability that hadn't existed before. Meanwhile, the investments kept growing quietly in the background. Some months looked great. Other months looked disappointing. But Jordan stopped reacting emotionally to those short-term movements. Instead of constantly checking the account every day, the focus shifted toward consistency. Invest a little regularly. Let time do the rest. One of the most interesting lessons Jordan learned was how psychology affects money decisions. Humans naturally react strongly to fear and excitement. When markets rise quickly, people feel confident and want to invest more. When markets fall sharply, fear appears and people feel tempted to sell everything. Ironically, those reactions often lead to the opposite of good results. Buying only when things look perfect usually means paying higher prices. Selling during moments of panic often locks in losses right before recovery begins. Jordan realized that discipline matters more than perfect timing. The goal wasn't predicting every move in the economy. The goal was staying consistent through both good and bad periods. Over the years, something else became clear. Financial progress rarely feels dramatic while it's happening. It's quiet, almost boring. There are no fireworks when someone makes a responsible financial decision. No applause when someone contributes to retirement savings or avoids unnecessary debt. But those small decisions stack on top of each other. Year after year, they create momentum. Eventually, Jordan looked back and noticed something surprising. The financial stress that once felt normal had slowly faded. Bills were still there, of course. Life still had expenses. But there was a sense of control that didn't exist before. Money had stopped feeling like a constant mystery. It had become something understandable. And that's really the key difference between people who struggle with money forever and people who gradually build stability. It's not luck. It's not secret knowledge reserved for experts. It's simply understanding the basic principles early enough to use them. Things like spending intentionally instead of automatically, avoiding high-interest debt whenever possible, allowing investments time to grow, taking advantage of opportunities like employer retirement contributions, keeping a financial safety net for unexpected situations. None of those ideas are complicated, but when people never learn them, they end up paying the price through unnecessary interest, missed opportunities, and financial stress. Jordan didn't become rich overnight. There was no sudden lottery moment. Instead, progress came from ordinary decisions repeated over and over again. And the most important part was realizing that financial knowledge isn't about becoming obsessed with money. It's about creating freedom. Freedom to make choices without constant financial pressure. Freedom to handle emergencies without panic. Freedom to plan for the future with confidence instead of uncertainty. Once Jordan understood that, money stopped being something confusing or intimidating. It became a tool. And like any tool, the more you understand how it works, the more useful it becomes. That as time passed, Jordan started noticing something interesting. The more attention given to money decisions, the less stressful money started to feel. Before learning these things, finances always felt confusing. Paychecks came in, bills went out, and whatever remained just sort of disappeared without much thought. But once Jordan started understanding the system, things slowly began to feel different. Instead of reacting to money problems, Jordan started planning ahead. One evening, while looking through monthly expenses, Jordan realized how powerful simple habits could be. Not extreme sacrifices, not complicated strategies, just small, consistent choices that slowly improve the situation. For example, Jordan began setting aside a small amount of money automatically every time a paycheck arrived. The amount wasn't huge. Sometimes it was only a small percentage of income, but it happened consistently. What made the difference wasn't the size of the contribution. It was the routine. Over time, that routine created momentum. Months turned into years, and those small deposits quietly grew into something much larger than Jordan expected. Watching that progress felt very different from the old feeling of wondering where money had gone. Jordan also started paying closer attention to how financial systems around us are designed. Many companies make money from people not fully understanding how things work. Credit cards, subscription services, banking fees, late payment penalties. These systems often depend on customers making small mistakes or overlooking details. Once Jordan became aware of that, it became easier to avoid those traps. Automatic payments helped avoid late fees. Regular account checks caught unnecessary subscriptions. Careful spending decisions prevented high-interest debt from building again. None of these steps required special knowledge or expensive financial advisors. They simply required awareness. Jordan also realized something about the way people talk about money. Often it sounds extremely complicated. Financial news uses intimidating language. Investment discussions can feel full of jargon. That makes ordinary people feel like they're missing something important. But when you break most financial ideas down to their basic principles, they're surprisingly simple. Spend less than you earn. Avoid high-interest debt when possible. Invest consistently over long periods of time. Take advantage of employer benefits when available. Build savings for unexpected situations. These ideas aren't exciting headlines, but they form the foundation of financial stability. Jordan shared some of these discoveries with friends and coworkers. Many of them had the same reaction at first. They felt like these topics should have been taught earlier in life. After all, people spend years learning subjects in school that they may never use again. Yet many adults enter the real world without understanding the basics of managing money. But the good news is that it's never too late to learn. Every small improvement compounds over time. Someone who starts making better financial decisions today can still create a dramatically different future compared to someone who ignores the problem completely. Jordan kept focusing on progress instead of perfection. There were still occasional mistakes. Some months were more expensive than expected. Life still delivered surprises. But the overall direction kept improving. Investments slowly increased. Debt gradually disappeared. Savings became stronger. Financial stress continued fading into the background. Eventually, Jordan reached a moment that felt surprisingly powerful. Looking at the numbers one evening, it became clear that the financial situation was no longer fragile. Unexpected expenses could be handled. Future goals felt achievable. Retirement savings were growing steadily. The feeling wasn't excitement. It was peace of mind. And that peace of mind is something many people underestimate. When they think about money, the real purpose of financial knowledge isn't simply accumulating wealth. It's creating stability. It's knowing that a single mistake or unexpected problem won't completely disrupt your life. It's having options when opportunities appear. It's feeling confident about the future instead of constantly worrying about it. Jordan's story isn't unusual or extraordinary. In fact, it's very ordinary. It's the story of someone who simply took the time to understand how the system works and then made small, consistent decisions based on that knowledge. Anyone can follow the same path. It doesn't require perfect timing in the stock market. It doesn't require winning the lottery. And it doesn't require becoming obsessed with money. It only requires learning the basics and applying them patiently over time. Because the truth is, the financial system isn't nearly as mysterious as it first appears. Once you understand the rules, you start seeing how everything connects. Income, spending, debt, saving, investing, they're all pieces of the same puzzle. And when those pieces finally come together, something important happens. Money stops controlling your decisions. Instead, you begin using money as a tool to build the life you actually want.